Bim, what's up folks? Nick Masunda here, video number 13. I'm going to be talking about how to purchase income protection in this video. Some of the parameters to look out for, what income protection is and why you should get it in the first place. So that's basically the aim of this video. Why should you listen to me? I've been working in life insurance or personal risk insurance and personal finance for about 7 years. So looking to try and help you guys make more informed decisions about your own insurance or personal finances. So what is income protection to begin with? So income protection is an insurance policy that pays out a monthly payment to you if you can't work because of a sickness or injury. Usually it's just sicknesses and injuries, and redundancy isn't included, although there are options, some options, limited options in the market that do this as well. Why should you take out income protection? Well, if you don't have it and you don't have an insurance policy, you're going to be relying on welfare or the dole or job seeker payment. The most you can get out of a job seeker payment as a single person is about $750 a fortnight. Okay, this is about $20K a year. So if you have any sort of assets or debt or anything, or any particularly high expenses, I mean, $20K per year is not going to be sufficient for a lot of people. Hence the need for some extra insurance. Now, work cover is an insurance policy that employers have to take out to cover their employees while they're at work. Some people think that this is sufficient. Maybe it is. I guess that there is. I mean, it's just a matter of knowing that you can't claim if you're at home and something happens to you, for the most part. Problem with this is there is at least some data that suggests the majority of injuries and illnesses occur at home. Okay, I've got a little bit of data from the National Safety Council in the United States of America. Yes, it is in America, but assumingly it's going to be pretty similar in other Western countries like Australia. And I'll put this on the screen, but you can see that about 3/4 of injuries that require medical attention happen at home. Okay, so that's a considerable amount that's not being covered by work cover. Okay, now when you go out and look to purchase an income protection policy, the first thing you're probably going to be thinking about is how much is it going to pay me each month. Or you might not be thinking about that much at all and just assuming you can get covered for 100% of your income. This isn't the case. Currently, the maximum you can get is 70%. Okay, 70% of your income. It might be worth looking at your expenses to see if that even is as much as you need. Okay, because the less cover you have, the less your premium is going to be. It has a pretty significant impact on the amount that you pay for your policy. Second parameter is going to be your waiting period. All income protection policies have a waiting period. This is how long you have to wait from the day you get sick or injured to the day you start accruing a benefit from the insurer, the payments from the insurer. All right, now 30 days, 60 days, 90 days is pretty typical, but you can have up to 2 years. 14-day waiting periods are also available, but not common anymore, and they're particularly expensive because the shorter the waiting period, the more you've got to pay for the policy. So with waiting period, the things that people generally think about when they want to choose a waiting period is how long is the longest I can have, because I want to pay as little as possible but still be protected. And that's going to come down to how much savings you have in your rainy day fund for the most part. Okay, you can take into consideration your sick leave as well. Some people have a lot of sick leave. The only issue with that is if you change employers, that resets back to zero and you start accruing sick leave again, typically. So that's something to consider, and savings is probably going to be the most important factor that helps you choose a waiting period. Then you've got your benefit period. So this is the maximum amount of time the insurer will pay you. Okay, if you take out income protection, you're not just going to simply be paid until you're well enough to go back to work. Some income protection policies will have a 2-year benefit period, some even a 1 year, some even a 6 month. Majority of retail insurers, these are the policies that you take out through an advisor, insurance advisor, financial advisor. You're going to have options of 2 years, 5 years, and up to the age of 65 for your benefit period. Most financial advisors are going to recommend up to the age of 65 because it's just the most conservative option, and it sort of covers kind of like a doctor is going to prescribe you antibiotics 9 times out of 10 because better safe than sorry. If a financial advisor says you should take out a shorter benefit period, like a 5-year or a 2-year, to save money, and then something serious happens to you, you get permanently injured, then they leave themselves open to clients coming back and saying, well, why did you suggest that I take out this short benefit period instead of an up to the age of 65 benefit period? So it causes issues in the future. But look, if you have a bit more higher risk tolerance, then paying less for a shorter benefit period might be something that you want to consider. Just obviously do it in an informed way, knowing that eventually that benefit period will end and you'll be on your own. Okay, so that's benefit period. Now, just quickly, also want to mention, with income protection, APRA, the regulator of the industry, in 2021 forced all the insurers to change their products to make them a little bit more profitable or a bit more sustainable. And that basically meant that it would become harder for people to stay on long-term claims. So frankly, the policies are not as favourable for customers as of 2021. So if someone has a policy that they took out prior to 2021, it may be more comprehensive and easier to claim on for them. So you'd want to consider that pretty seriously if you were looking to change today or in the future. One of the ways that they are more favourable prior to 2021 is that for the entirety of a claim, even if you had the benefit period up to the age of 65, the policy would be own occupation, which means that if you can't do your own occupation that you were working in prior to your claim because of your injury or illness, then the insurer has to continue to pay you each month, right? And that didn't matter if it was a short benefit period or long benefit period. Now, if you have a benefit period up to the age of 65, it will only be own occupation for the first 2 years, typically. I'm not aware of insurers that are offering up to the age of 65 with a longer than 2-year time frame that's own occupation. What do I mean by that? Own occupation, like I said, means if you can't do your own job, you continue receiving the payment. After that 2-year mark, you have to be unable to do your own job or any job that you're suited to based on your skills and qualifications. Okay, not just so then they're not going to expect you to do anything at all. It has to be something that you're suited to, but it still opens up the amount of roles that you can do and therefore reduces the likelihood that the insurer will have to keep paying you after that 2-year mark of being on claim. Okay, this is obviously of no consequence if you have chosen a 2-year benefit period, right? Prior to 2021, it doesn't matter because you can still. I mean, this isn't the only difference, but from the point of view of the benefit period, prior to 2021, if you had a 2-year benefit period, you can still get an own occupation for 2 years on a benefit period today. And just in regards to the 5-year benefit period, a lot of the times there will be that change from own occupation to any occupation at the 2-year mark as well. Some insurers that allow own occupation all the way for the full 5 years still today include TAL, AIA, Clearview. So yeah, that's just a quick comment on, well, maybe quick, maybe long-winded comment on the benefit period and the change from prior to 2021 to today. You can also choose a premium structure if you're looking at a retail policy through an advisor. You've got step premiums and level premiums. I've talked about this in detail in another video, but basically step premiums will go up every year with your age, and level premiums don't go up with age, but they do start off more expensive. And just a quick comment on retail policies, which I'm talking about for the most part here, which you can own outside of superannuation or inside of superannuation, versus policies that are held and offered by your super fund. Okay, when you have your policy outside of superannuation, one of the positives is that the premiums are tax deductible. Okay? This is particularly positive for people who are in higher tax brackets. When it's inside superannuation, it's still tax deductible to the super fund, but the contribution tax rate is 15%. Okay, it's not going to be as high as some people's who are in the highest tax brackets at like 45% or whatever that tax bracket is, that highest tax bracket is, or even lower tax brackets like 30%. So that's one point of difference. I have noticed that some super funds offer very price competitive income protection though, some of the industry super funds. So this is a trade-off that you'd have to make for yourself based on what marginal tax bracket you're in and what kind of quotes you're getting from a super fund. So you just have to go and get quotes, retail quotes, superannuation offering quotes as well, and just compare them and see what's going to suit you best. That's pretty much everything I wanted to cover off. Thanks for watching.